Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney, where markets have just come online.
I'm Annabelle Droulers in Hong Kong. We're counting down to Asia's major trading opens and the top stories this hour. Apple shares lower despite its first revenue gain in a year. China sales slumping the most since 2020, with CFO Luca Maestri telling us they're not happy but continue to see long-term opportunity. Meta soaring, though, on a strong forecast, a share buyback and its first dividend. Amazon's outlook also pleasing investors. Also coming up, we'll hear exclusively from Nvidia CEO Jensen Huang on the AI frenzy that's driving demand for their chips.
We do have South Korea CPI just crossing the Bloomberg here, and we are seeing that slowing even more than expected. Expectations were for inflation in South Korea to slow to 2.9% on year for the January reading. It actually has come in at 2.8%, so really a significant pullback from the 3.2% that we saw in the prior period. Month on month, that is 0.4%, matching expectations. And if you strip out the more volatile and food and energy elements, we're seeing an inflation rate of 2.5%, again slower than that 2.7%, and pulling back from 2.8% in the December period. CPI gains have really been still seen as too high for the Bank of Korea's liking, but it does appear that food prices in particular are rising a lot more slowly. The cost of gas at the pump is continuing to fall as well, and that expectation, particularly when it comes to core CPI, coming down more than expected. We did hear from BOK Governor Rhee saying that inflation remains really the most important task for the central bank. They'll be watching that very, very closely. Let's get you to how we're setting up when it comes to Asian markets. And Australia is just coming online at the moment, and we are watching in particular further downside when it comes to materials and miners, as we see that fall in base metals, the concerns over price volatility as China enters that off-peak season ahead of Lunar New Year. We're seeing really quite a flat start, a little bit of downside there when it comes to some of those miners there. But broadly speaking, Aussie markets up by just about 0.1% as we get into the start of staggered trading there. Also watching the Aussie dollar holding pretty steady at 65.74. The US dollar, though, on pace for the biggest daily drop this year. We saw Treasury yields slipping. Really these renewed concerns about the health of US banks. We also had, of course, Fed expectations in the mix, as well as the BOK leaving policy rates unchanged as well. Switching out the board to take a look at how we're setting up when we get into the start of trading across other major Asian markets now. This is the setup when it comes to Japan, as we are really expecting this to be potentially a little bit of a quieter end to this week, as we have, of course, Bell, that focus when it comes to the big tech earnings driving the narrative today.
Yeah, certainly not a quiet end to the week on Wall Street here, because there's a lot of different movers we're tracking in after hours. But just kicking off what we're seeing with those two ones here in green, Amazon, Meta, both of those giving pretty bullish numbers to the markets across a different variety of metrics. We'll get more on all of this in just a moment, so I don't want to get into too many details. But just to say as well, we're seeing that drop there for Apple. Again, it actually did have some pretty good numbers overall, but investors and traders, they're just focusing on the China figures, and we did see a bit of weakness coming through there. So concerns around the health of the iPhone demand coming from mainland China. Intel, one to note likewise, we're actually seeing its shares dropping here, but that is not an earnings story. It's the reporting that's coming through from the Wall Street Journal saying that they're delaying their $20 billion chip plant in Ohio, now seeing completion for that in 2026. Intel, one of the companies that did kick off the reporting period earlier this week. And again, we did see that big drop for the share price, down more than 10% in reaction. Let's switch it out, take a look at how broader futures are coming online today, because we are seeing the Nasdaq again pointing to further gains in the session, and futures so far up nearly 1% at this point in time. US futures as well. So we're still trading above that key 4,900 mark. A lot of investors pretty optimistic, given what we've seen as well over the course of this reporting season. Oil, a fairly choppy trading session yesterday, but again, we are just seeing it a little bit higher. One stock to note intraday on Wall Street Street as well was Amer Sports. That company closing 3% above its US IPO price. It was a first-time share sale for the company that was done below a marketed range, but still the biggest one we've seen since Birkenstock's $1.5 billion listing last year. But again, it is that focus on the earnings story and Apple's ones in particular. So let's bring in our Bloomberg Originals host, Emily Chang, who's joining us today. So Emily, we know that you spoke with the CFO, Luca Maestri, and let's just start with what they said about China, the revenue decline there. What did you hear from him exactly?
Yeah, we're seeing a meaningful decline on sales in China, and this was somewhat to be expected, but I think perhaps a little bigger than some expected. He said the iPhone in general did better than the overall products, that is, declined less than some of the other product categories in China. They did have, a record install base. They did have a strong growth in upgraders. And what he said was, we're not happy with the decline, but we know China is the most competitive market in the world, and we continue to see significant opportunity in China over the long term. Obviously this is an incredibly important market, but I was just listening in on the call, and they were really highlighting some of the growth they're seeing in other markets around the world, other emerging markets like India, for example. Tim Cook, the CEO, specifically called out India. So definitely not good news what they're seeing in China, but certainly there is the potential for other markets to pick up some of the slack.
Emily, what was the messaging around the health of the iPhone overall? There's a lot of concerns, some of which you've already alluded to in terms of how broader demand is going to hold up.
Totally. Longer replacement cycles. In China specifically, we've heard that they're cutting the price of the iPhone there. There's a ban on foreign workers, on workers using foreign technology at work. In general, the iPhone still a beat, record number of installs globally, record number of upgraders globally, strong double-digit growth in many emerging markets. So, the iPhone, isn't necessarily the problem here. When you look at some of the other product categories, we saw a big decline in sales, not only in China, but also in the iPad, in wearables, home, and accessories. The comps are a little tough here because the quarter was 1 week shorter than the quarter a year ago. They also talked about some currency issues. They missed on Mac and services also, though they did hit an all-time record on services. So I think that's why you're seeing the weakness in the stock after hours.
What is pretty cool is that these numbers coming on the eve of the launch of its new headset, and you actually got to try it out, Emily, the Vision Pro. So what did you think about it?
I thought it was pretty cool. And I know I'm a journalist and I'm supposed to be skeptical, but there are so many technological innovations packed into this device. And some of the things that are the most amazing are the most basic. The fact that you can just look at a virtual button and tap your fingers and it opens, and suddenly you're in a room with dinosaurs, or you're driving a race car, or you're standing on first base watching a baseball game. It is so vivid and so real. And, I personally love the family photos and family videos. If they're shot in spatial mode, they show up in 3D. I mean, it's really moving. That said, this is a $3,500 device. It is incredibly expensive. It can be kind of an isolating experience. It's not easy. It's not an easy device to share because you've got to change, the band that goes around the headset itself. And the real question is, are developers going to show up to the party? What is the killer app going to be? Netflix isn't developing a Vision Pro app yet. YouTube isn't developing a Vision Pro app yet. We don't necessarily know what exactly the main use case is going to be. Certainly it could be gaming and entertainment. Luca Maestri, in our discussion, really called out the enterprise and talked about how a lot of companies are already developing for the Vision Pro and are really excited about that. That's something Tim Cook echoed later on the call. So we're really going to have to see what happens tomorrow when this starts selling in the United States. They do have a lot of pre-orders. It's already on back order. But, this is going to be a niche product for the foreseeable future. And it's going to be a very long time before it could be something bigger than that. And certainly the price would have to come down.
Yeah, I think you had me at Walking with Dinosaurs, Emily, but yeah, 3,500
It was pretty cool. I mean, you got to like touch the faces of the dinosaurs. They're breathing in your mouth. I mean, it was intense. It was intense. And really, like, you know, they show you rock climbing and you get that fear of heights because you look down and it feels like you are standing on the edge of a precipice. So I don't want to, you know, I don't want to underestimate just how powerful the technology can be. It's just, will this be, you know, a blockbuster device? That's what we don't know yet.
Emily Chang, our Bloomberg Originals host there. Well, aside from Apple, we also saw Amazon and Meta reporting earnings, both giving upbeat outlooks. Let's get the details from our Bloomberg Intelligence senior e-commerce analyst, Poonam Goyal. Also, our Bloomberg technology reporter, Kurt Wagner, joins us as well. So, Poonam, let me start off with you on Amazon. Bloomberg Intelligence seeing profit rising further. What are the drivers for you?
Yeah, I think Amazon today just proved that it can continue to grow on all fronts. What stood out to me was three things. One, the online business. The 9% sales gain that they reported on their first-party business was very impressive, and it was an acceleration over previous quarters. Also, the 20% third-party sales that they showed the increase was sizable. You know, we expected mid-teens gains, but the fact that they were able to deliver 20% shows that sellers continue to flock to Amazon to get the eyeballs and the spend of shoppers. That combined is ammunition for them to continue to grow sales into 2024. But that set apart, you know, with that online business growing, what it brings with it that's very lucrative is the advertising business. The digital advertising business grew 27% on a reported basis. That's a sharp acceleration from the low 20s that we've been seeing, and it is one of the largest contributors to profit. In fact, if you looked at the profits that they reported, they were the best ever, especially in North America, and that is in part due to the strength that we saw in advertising and also the gaining momentum that we saw in the cloud business.
Yeah, I want to pick up on the cloud business because we did see it rebounding after several pretty disappointing quarters. But do you think, Poonam, that there's any doubts that they're going to be able to hold their own against rivals in the market?
I think the cloud business is only poised for upside. As we continue into 2024, we expect these gains to accelerate into the high teens. And for the longer term, if you look a few years out or even 5 years out, the cloud business is very lucrative for them. Right now, the margins are near 30%, but we think that margin profile can go up to 40%. And the cloud business could be much, much bigger than it is today. Amazon is clearly making the right strides to lure businesses into its cloud platform, and we think it will remain a dominant share there.
All right, and then, Kurt, of course, there's the Meta earnings as well, and I think what really stood out from this was this first ever quarterly dividend. Was this something that was at all expected by the market? And just also tell us what's the significance of it?
No, it was not expected, and I think it's a big deal because obviously 2023 for Meta was sort of this year of efficiency. They were cutting jobs, they were cutting back on some of their investments, and so this sort of signaled that, you know, they're at a place business-wise where they feel that they're able to give back to investors here. They're also announced another $50 billion approval to do a share buyback. So I think there's this clear effort here to, you know, convince investors that, hey, even though we've cut down and slimmed down, you know, there's still a lot of return for you to buy into this thing as we move forward to the AI and the metaverse and sort of these ambitious bets that Mark Zuckerberg has.
And Kurt, there's going to be some differences in terms of how Meta reports its numbers going forward. You know, for the longest time, obviously, we've been focused on user numbers, but that's no longer the highlight.
Mm-hmm. No, it's not. They're going to stop reporting the daily and monthly active users for Facebook, the core social network. They're also going to stop reporting the monthly active users for their family of apps. You know, instead, they're going to focus on things like, you know, how much revenue are they making per user? You know, they're going to focus on other kind of efficiency elements of the business. And I, you know, this is something they've sort of been warning about for a couple of years now. I think we all expected that when this happens, it's sort of a sign that Facebook, the core social network, has sort of plateaued, right? They don't want to continue to roll these numbers out if they're not going to get bigger. So I imagine maybe they're starting to reach that point. But, you know, again, as they start to expand into these other technologies and other business lines, it sort of makes a little bit more sense that they wouldn't just focus on the one core social network that we're all used to.
All right, pretty big numbers out after the bell. And of course, as we know, Amazon and Meta, both of those rising in after hours. But that was our Bloomberg Intelligence senior e-commerce analyst, Poonam Goyal, and also our Bloomberg tech reporter, Kurt Wagner there. Coming up, we'll take a look at the wider markets with Miramar Capital and why they expect choppy trading in the first half of the year. We'll get more on their outlook next. This is Bloomberg.
We don't think the trade is to then, go to the lower quality bucket, okay? To go for the low quality cyclicals. And that's a recession trade. We're not in a recession. You need a clearing event. That was our call in 2020. Then that worked really, really well. Don't overthink it, right? You need to buy the high quality growth stocks, and it's not all Mag 7.
Was Morgan Stanley Chief US Equity Strategist and CIO Mike Wilson there. Speaking of the Magnificent Seven, our next guest has Microsoft as one of their largest holdings. Max Wasserman is the founder and senior portfolio manager at Miramar Capital, and he joins us now. Max, great to have you with us. So we've got earnings under our belt now. What did you learn, and how does it kind of inform how you feel about, again, this return to a narrow kind of focus in this market now?
Well, I think some of the earnings have been great. I mean, if you look at what happened with Microsoft, basically a 16% increase in revenue, 28% increase in earnings per share. Azure grew 28%, and 6 points of that was basically AI. So you're hearing good numbers from like the Meta, you're hearing decent numbers from Amazon. The one caveat is you're not hearing great numbers from Apple. So Apple looks, among all the companies, and we have an investment in Apple, is looking like the slower technology of all of them.
Max, how does the Fed's timing kind of feed into this, right? I know that you're in the camp that markets have kind of run away with expectations a bit.
Well, I think the market pulled forward a lot of earnings in technology, and basically the market was anticipating 3 to 4 cuts, I think, by the mid-June. We don't think the Fed's going to be cutting to the second half of the year, and at best, maybe we'll see like 50 to 75 basis points. We think the Fed may cut towards the end of second half. But we think the market's overly optimistic on it. And given the fact that technology had such a big run since October, we think it's just ahead of itself right now.
So then how does that sort of set you up for trading, do you think, over the course of the first half, if some of those returns have sort of been pulled forward in these numbers?
Well, we think, again, the market in general, we think, is fairly valued. It's just skewed in the indices because of the large cap tech. But we think there's a lot of great opportunity in the market. We like the consumer cyclicals. We like some of the financials selectively. We like the industrials. We're dividend growth investors. So we think outside of tech, the market's fairly valued and there's more opportunity there.
Yeah, a lot of the time we do talk about that so-called S&P 493, rather, not these Magnificent Seven in the mix. Do you think that investors need to be positioning for any sort of downturn? Do you need to be moving more into cyclicals or defensive,
sure,
rather?
I think it's a great question. What we look in, we think investors should look to shorter duration assets, meaning dividend stocks and shorter term bonds, like 1 to 3 year treasuries actually look appetizing to us. But we think the risk is going to come because the valuations are so high and anticipation of interest rate cuts we don't believe is going to materialize. And we also think that inflation is going to be a little bit stickier on the way down versus the way up. So we think there's opportunities, but not just to focus on the top 7 technology stocks. There's a whole area of the market, consumer industrials, the cyclicals. If you look at the financials, there's some opportunity there because nobody's really been looking at that area. They've all been focusing on the technology area, which is an interesting statistic if you look at technology. Over the past 3 years, the NASDAQ composite's pretty much only giving you a 6% annual return versus the S&P, which is giving you almost a 9%. So technology, while it's very catchy, we like it. We have investments in a lot of technology companies. We just think it's ahead of itself and there's better areas to be looking.
Amazon clearly is still doing very well, but broadly, are you a little bit more concerned about a lack of predictability when it comes to the consumer?
Right. I think when you look at like B2B, we're more consistency. When you look to consumer, it's still the issue of inflation. The consumer is tapped out a little bit, but they're still spending heavily. Consumer credit's very high. So we think it's going to take them a little bit. And they'll benefit in the second half when you start seeing interest rates come down. But right now, we think it's going to be a little bit much more of a stock selection area while the consumer tries to find their footing. They're really spending on experiences, less on capital goods. But we think that it creates an opportunity in the long term.
There is an extraordinarily heightened level of geopolitical risk at the moment, right, going into the end of last year and 2024. Has it surprised you how sanguine investors have been about this? And is this a risk that perhaps we should be assigning a little bit more attention to?
I think political instability is always there, but it's at a heightened list right now with the Middle East, Asia, and Eastern Europe. Absolutely. But clearly, what really moves the market on a long-term or even an intermediate basis is really Fed policy. Yes, you can have shock to the systems, but there tend to be shocks. It's really what the Federal Reserve is doing. It's what credit availability is. It's really monetary policy that affects the market the most. So yes, you can always be aware. Yeah, you could have a spike in oil because of a problem in the Red Sea. But we think all those things will be short-lived. Right now, the market's not anticipating it, so you may have a bigger move if you have a geopolitical issue. But again, we would think that would be short-lived.
Something that's not so much a geopolitical issue, but certainly something that could have the potential to move markets would be the US election. So given the significance of Fed policy, if we do see any sort of uptick in fiscal spending ahead of that vote, do you see that having an impact at all?
I think if you started seeing more fiscal spending, right, you're going to have more debt. And more debt is going to cause interest rates to go up. And I think that would not be good. Again, the economy is growing right now. But if you put too much more debt on it, then you're going to have a lot of the expenditures of the government servicing that debt. And that could slow the economy down, which in turn we believe would cause the Fed to try to cut interest rates to lower their service costs. And that would stimulate. But you could see some problems ahead with the U.S. debt. And that's a problem. But right now, the market doesn't seem to care. And by the way, we know the Fed's going to cut. It's not if, it's just when. And when we know they start, the market will anticipate that. And we think that's, again, towards the latter half of this year. So you could get some rockiness for the first quarter or two.
All right, that was Max Wasserman, founder and senior portfolio manager at Miramar Capital there. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to DayBgo. It's also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get news on the industries and assets that you care about. This is Bloomberg.
I think we've now changed the question, really, from how restrictive do we need to be to for how long do we need to be restrictive. That's important. We've also taken the upside bias off. We have included a risk, by the way, a new risk, actually, which is really reflecting, obviously, sort of tragic events in the Middle East and the impact that can have through the Red Sea effects. So I think now the question is, for us, is really for how long do we need to maintain this stance going forwards? As I've said a number of times, we're not making predictions at this point.
That's the BOE Governor Andrew Bailey speaking with Bloomberg TV after the central bank's decision to keep its key rate unchanged, but of course opening the door to rate cuts, and that was really the focus of that meeting. It was importantly the widest division on the direction of policy we've seen for the bank in a number of years, and out of the 9-member voting committee, 2/3 did want to keep the key rate steady, but 2 voted to hike, and importantly 1 of those wanted to cut. But we are seeing that pound moving a little bit in the session, and currencies generally a bit stronger against the greenback. But the Chinese yuan is also in focus. The PBOC says it provided $20.9 billion worth of low-cost funds for lending to housing and infrastructure projects last month. The pledged supplemental lending program is a tool for Beijing to manage the impact of its worst property downturn on record. Authorities have been stepping up policy support for the sector recently. Coming up, analysis on the latest tech earnings with Third Bridge. We discuss Apple's China woes, as well as Amazon and Meta's rosy outlooks next. You're watching Daybreak Australia and taking a look at some of these big tech names in after hours here, because we had Apple, Meta, Amazon, all of these reporting after the bell today. And you can see here some pretty divergent directions. You've got Apple there in the red. It's sales to China. That was the key weakness for the company. So sales dropping 13% in the 3 months ending December. So really quite short of what analysts had been expecting of 23.5 billion, so around a $3 billion difference. That's the weakest December quarter we've seen in the Asian period, or Asian nation rather, going back to 2020. To the flip side, you've got Amazon and Meta, both of those companies delivering very bullish numbers, and Meta really standing out with that 15 or near 15% gain here. So let's get more on it now with Scott Kessler. He's global sector lead for technology and media and telecommunications at Third Bridge. Now, Scott, we were just talking there in the ad break about Meta being the company that's really standing out to you at this point. Why is that exactly?
Sure. Well, I mean, look, earnings season is relatively young at this point. I could argue it's really been less than a week where we've seen major companies reporting their December quarter results and providing related guidance. I think prior to the results we're talking about, Microsoft was probably held out as the company that delivered most significantly across a number of different dimensions, whether you're looking at revenues, you're looking at revenues across multiple kind of segments within the business, margins, et cetera. But if you look at Meta, as you alluded to, Meta's revenues were up 25%, driven by strength in advertising. It seems like the company is really not just back on track, but really executing strongly. And I think it's really a testament to two things. One is the company's ability to kind of focus and pivot on what's most important. And then, of course, wrapping up their so-called year of efficiency in 2023, that really helped them from a margin perspective.
Yeah, it's interesting because if you were to go back to October last year, we heard from Meta executives and they were saying that global economic uncertainties could be something that would weigh on revenue. But actually, Meta did a lot better than, say, Alphabet, which also gets a lot of revenue from digital advertising and is also investing heavily in AI.
Yeah, I mean, it's hard really to understand at this point the distinctions in terms of why, say, Meta performed so well, but yet Alphabet was really more mixed. I think it's fair to say if you looked, for example, at Alphabet's search and advertising revenue performance, I think it was good, but it was not as good as some people might have hoped and some actually expected. In the case of Meta, it seems like the results were not just good, they were very good and in excess of, I think, just about everyone's expectations that, are looking at and following this company. I think there are a couple of conclusions that one could draw. I think one obvious one is that Meta has been more focused on monetizing some of its more emerging assets, most notably Reels, which is obviously a short-form video product. They seem to be doing really well there. We've heard from experts time and time again that not only were they performing well, but that the future looked bright when it came to Reels, even though, of course, there has been an uphill battle as the product competes with TikTok. It seems like that particular offering is performing really well. On the other hand, I think there are some questions around YouTube and YouTube Shorts, which is obviously Alphabet's kind of entrant into that short form video race. And I think that's one way to distinguish among the two companies and how they performed over the quarter.
And Meta's obviously taking, I guess, more of a longer-term view as to how it strategizes on AI, right? Do you think, the availability of these large language models for free is going to, at some point, irk investors who want more of a monetization strategy when it comes to artificial intelligence?
Right. So if you're talking about Meta more specifically, I think it's fair to say that they're taking a more pragmatic approach. A couple of indications of that. I think first things first, right? If you think back to 2+ years ago where the company renamed itself Meta Platforms and reoriented around the metaverse, They created two segments, Family of Apps and Reality Labs. It seems pretty obvious that they've been pulling back investment from that Reality Labs segment. And nothing could be a stronger indication of that, at least in my opinion, than the fact that Mark Zuckerberg, I guess it was now, a week, 2 weeks ago, publicly announced essentially that the AI group that consists of roughly 1,000 people was going to be realigned under the Family of Apps, which tells me that really what AI is going to be at Meta is kind of supporting and helping those existing products and offerings with enhanced kind of functionality when it comes to AI. It seems to me like the goal here is to really kind of prop up and squeeze as much opportunity out of what Meta is already doing when it comes to existing businesses and solutions. And I think that's pretty noteworthy as people wonder about whether this is capital well allocated, so to speak.
Scott, from Meta to Apple, which obviously was a lot less in terms of the good news, is this just a China demand story, or is there kind of more existential issues now with China's product, with Apple's product demand and the product cycle more broadly?
Sure. I mean, I think it's fair to say that for years and years, people could point to the law of large numbers being kind of an impediment to Apple delivering outsized growth. But the good news is obviously that the company, in fact, did deliver revenue growth for, I think, the first time in over a year in the December quarter. However, I think it's fair to say that there is a fair amount of, let's call it, conservatism and skepticism when it comes to not just the results, but the go forward kind of opportunities for the company. Even a standout segment like services only generated 11% growth. I think that was less than expectations. And I think Apple overall has sounded a tone suggesting that growth is going to be more elusive over the near term. And so this is a company that, not a lot long ago was really generating substantial growth. And now I think there are some questions about where, in fact, that growth is going to come from when you see a mobile phone market that many would suggest is saturated with already very premium pricing.
Scott, really great to have you with us. Scott Kessler, Global Sector Lead for Technology, Media and Telecommunications at Third Bridge. You can, of course, turn to your Bloomberg for much more on really all of the big tech earnings. TLIV Go is where it's at for commentary and analysis from Bloomberg's expert editors. Taking a look at some of the other corporate headlines that we're following this hour, and Universal Music has begun pulling music from TikTok after months of contract negotiations with the app's owner ByteDance failed. The label was home to artists including Taylor Swift and Drake. Universal says the rights offer was below market value, but TikTok calls that, quote, a false narrative. The label also says TikTok's adoption of AI tools to generate content is a major threat to artists. The Wall Street Journal says Intel is delaying the construction timetable for its $20 billion chip-making project in Ohio. The report cites sources saying construction isn't expected to finish until late 2026. Intel had initially targeted chip production in 2025, with the plan also dependent on US government grant money. Amer Sports shares gained more than 3% on debut in New York. That's after the maker of Wilson tennis rackets and Solomon ski boots raised almost $1.4 billion with an IPO marketed below range. The CEO, James Jung, told us that the pricing was frustrating, but believes it only reflects a short-term view.
We built up the very solid foundation in the past 4 years and basically help us to really can have a good moment in the future. So I think internally our company has still got the very high confidence to continue to grow to grow our business at the right level. And the price point, it's a bit frustrating at the starting point, but I think it's just a short-term view on this. And my management team and I still got a very high level of confidence to drive the value for the company and create the best value for our investor in the future. So there's no worry about that.
What made the IPO an attractive option here to reduce your debt load and fund future operations rather than doing that privately?
Yeah, I mean, it's, we grow the business more than 20% CAGR in the past 4 years. We built a very strong foundation. And today from now, we still also build a very aggressive vision for our future growth. IPO will really unleash the potential for us by leveraging our overall debt situation and give us more cash flow to fuel our three brands, Arc'teryx, Salomon, and the Wilson grow at the pace we want. So it's a kind of engine, okay, for us to really speed up the whole progress growth in the future.
When companies go public, it is very well known they now have equity. They have stock here to potentially pursue more acquisitions. Are you, Anta, still eyeing more acquisition opportunities after building such namesake brands? And what are the criteria, if so?
No, basically, we got the good level of portfolio brands in our company. All these three hero brands, they just exceed $1 billion US. They are still medium, small players in the market. So we see tremendous potential to be explored in the future for these three major brands. So for coming 3 years, we will really focus on where we are at this moment. And after 3 years, we may see some opportunity outside.
That was the Amer Sports CEO James Jung speaking to Bloomberg Shonali Barsik in New York, and we'll have more ahead on Daybreak Australia. This is Bloomberg. You're watching Daybreak Australia. Time for morning calls ahead of the Asia trading day, and economists are taking Fed Chair Jay Powell's words to heart and are raising the last of their forecasts for a rate cut in March. Goldman Sachs, Bank of America and Barclays now see the first easing in May. Powell acknowledged the dramatic progress in inflation, but has repeatedly emphasised the need to see more data to confirm that downward trend. Meanwhile, Nobel Prize-winning economist Paul Krugman is playing down the damage that Donald Trump's tariff plan would do to the US economy. Speaking to Bloomberg, Krugman said Trump's idea of a 10% tariff on all imports wouldn't hurt the growth that much.
A dirty little secret of international trade economics is that moderate tariff rates do not, at least according to our models, and as far as we can tell in practice, don't have huge growth effects. They distort consumption and production choices. They do some damage, but to get really big numbers, you have to get well beyond 10%. So, of course, if the goal is to eliminate the trade deficit, Lighthizer was going to have a surprise because tariffs don't eliminate trade deficits unless they get so high as to basically make trade impossible.
Well, Morgan Stanley's chief US equity strategist and CIO, Mike Wilson, says investors should be on the lookout for new themes after the tech rally. He also spoke to us about the growing impact of AI.
I'd say it started with the Treasury squeeze when they said they're going to issue less coupon. So it was really a duration rally that then fed into a stock rally. And so now valuations are stretched again, and people are looking around going, okay, what's next? What's the next catalyst? I think there's going to be a couple things that will determine the direction. Number one, how much deceleration do we get? Okay, we'll come back to this banking question. I think that's, to me, that issue is not a systemic issue. What it is a weight on credit growth. Okay, the regional banking system is just not lending at the same rate that they were because they're constrained, and that's been our view all along, which means quality stocks will continue to do better, right? The companies that are reliant on that kind of funding are going to continue to see that's a paperweight for them. And I think that's the main takeaway from the banking situation. And then, of course, new themes will evolve. Last year was about two main themes, right? It was about GLPs and AI. So can those two themes continue to drive the stock market? Yeah, to some degree, but it's probably going to morph a bit, and then there'll be new themes. And I think that's what investors are looking for now, looking for new themes to kind of latch onto in a world that's going to remain macro uncertain, is the way I would say.
Can you identify any themes right now?
Well, I think the AI theme is the one. Instead of enablers, we're going to adopters, right? So that's probably the biggest theme we have as a firm. The GLP one is sort of positive and negative, as we've seen, and that's a great thing for long-short investors. And then I'm wondering if we're going to get some growth out of the international markets finally. International, economies have not really recovered from the pandemic yet, for the most part, and I think that's a wild card. So if that were to happen, that could be a great theme for EM. It could be a theme for things that are levered more to global growth as opposed to just the U.S., which has really been the only engine of growth.
Since you say that you fly around and you talk with clients, I was just noticing some of your recent travels. You were recently in Miami.
Yes.
I imagine you're getting a lot of points, by the way. You talked about the AI stock, saying, I think it's the Magnificent Four now, and it's related to earnings. Who are the Magnificent Four? Who gets dropped?
Yeah, well, I mean, I think it's, we're not talking about specific names, but I think it's obvious. People have been talking about this too. I'm not the only one, right? We're seeing, you can identify which stocks have fallen off. But what we look at is earnings, okay? And I would say there's a Magnificent One, quite frankly, that has real top-line acceleration growth. Everybody knows what it is. And then the other ones are been more cost-cutting stories.
It rides with NVIDIA?
Yeah, and my sense is that what we're going to see here is a broadening out in quality growth.
That was the Morgan Stanley Chief U.S. Equity Strategist and CIO Mike Wilson there. You can watch us live and see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions we talk about, plus become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go.
Take a look at some of the corporate headlines that we're following. And 7-time Formula One champion Lewis Hamilton is joining Ferrari next year, leaving his longtime team Mercedes. Ferrari says Hamilton will join on a multi-year deal. Meanwhile, the carmaker's shares rose on Wall Street after it set a better than expected guidance for 2024 thanks to a strong order book. Revenue for the fourth quarter also beat expectations. Wall Street banks, including JP Morgan and Bank of America, are said to be in talks to provide as much as $8 billion in financing for a buyout of DocuSign. Sources say Jefferies and Deutsche Bank are also among the lenders considering a role. Bain Capital and Hellman & Friedman are jockeying to buy the platform in what could be the largest leveraged buyout of the year so far. Shares in Deutsche Bank rose after it announced plans for a $733 million share buyback and detailed cuts to 3,500 jobs. The reductions will affect mostly back-office roles and are part of cost-cutting measures the company had previously announced.
We have focused our efforts on what we call non-client-facing staff, where there's been a significant change over the last several years around internalization of activities, the control investments that we've made, the investments in technology. And so having reached a level of maturity in some of these areas, I think the goal now is to drive efficiency without losing effectiveness. So yes, that's where the staff cuts are targeted.
Well, sticking with financials, and analysts will be watching Mizuho's domestic bond portfolio and lending spreads when it reports earnings later Friday. For more, let's bring in Bloomberg's Asia investing editor Russell Ward in Tokyo. So, Russell, a very, very busy week for the Japan lenders and financials in general. What are you expecting out of this one?
Good morning, Belle. Yes, I think with Mizuho's case, we're expecting quarterly profit to actually drop, mainly due to weakness in trading. But that's really just not going to derail their full-year outlook, which is actually for profit to rise to the highest in 8 years. So, putting that quarter aside, I think the bigger picture for the mega banks, at least in Japan, is a bright picture. It's one where they're riding on the coattails of Japan's market recovery, which has been boosting the brokerage business here in Japan. And of course, there's also great anticipation here that the Bank of Japan will finally end its negative interest rate policy, which is going to boost lending profitability. And we've seen Japanese bank shares rise over the past year to reflect, those expectations.
Sumitomo Mitsui reported high profit yesterday as well. Talk us through those results. Is it kind of closer to meeting its goal when it comes to annual earnings?
Yeah, that's right. Sumitomo Mitsui had solid results yesterday, buoyed by strong lending. They're also benefiting from the weak yen. Remember, the biggest Japanese banks actually generate a lot of their earnings overseas these days, so those repatriated earnings in yen terms are growing as well. And also it benefited from a rebound in its brokerage unit, SMBC Nikko. And so really it's still on track for record profits this year, which is a boost for the new CEO, Toru Nakashima.
And we've got to talk, of course, about Alzora, because that was a huge plunge yesterday for the stock, down more than 20%. Warnings about losses potentially on US commercial real estate. Just talk us through exactly what happened, and as well if we're going to see similar moves from other Japanese banks.
Yeah, that's right. I mean, Alzora certainly spiced up the Japanese bank earnings season. I mean, the main banks, the big banks, sort of chugging along. But here came out of the blue this mid-tier Japanese bank, Alzora, booking the surprise forecast reversing its forecast for full-year net profit to now forecasting a loss. And this is based, as you mentioned, on expected reserves there, booking on expected losses on their US commercial real estate portfolio. And so Alzora has just become the latest victim of banks worldwide. We saw New York Community Bank Corp this week also book losses on US real estate, reflecting the downturn there, reflecting high interest rates, people working from home. Is this a canary in the coal mine for Japanese banks? Probably not. Analysts are saying that the mega banks in particular, they're very large banks, very diversified. They've got huge balance sheets. And also Japan's regional banks are very conservative. They've got a strong customer base at home. Alzora is sort of caught in between the two of them. They're a city bank, but they're a mid-tier bank, and they really just pursued the strategy of buying or making loans overseas to sort of juice their profits, and it's falling back on them. But it certainly raised a lot more attention to Japanese bank earnings season. And we'll be looking for any more surprises to come, but probably unlikely on this front.
Now, Japan financials in focus. Bloomberg's Asia investing editor, Russell Ward, there in Tokyo for us. Take a look at some of the stocks among those. Japanese banks, of course. Trade opens in Korea, Japan shortly, in just about 5 minutes. In fact, we're seeing these markets come online, and watching Apple suppliers, of course, a 13% quarterly sales slump in China, even as total iPhone revenue came in stronger than expected. There's lots of difficult questions there over the product cycle and whether that sustained demand, when it comes to these big numbers that we're used to seeing from Apple, can really continue. So on the radar are the likes of Samsung, SK Hynix, LG Innotek and Sharp as well. But coming up, we'll be hearing exclusively from the former NVIDIA CEO Jensen Huang on the AI frenzy that's driving demand for chips. The market opens in Seoul and Tokyo are next. This is Bloomberg.